Hey, Steve Saretsky here. Welcome back to the show. Lots to touch on this week. We've got an update in Canada's CPI inflation. We've got some movement and contagion in the bond market, how that's filtering through into mortgage rates and the real estate market. I'm going to give you the one thing that I'm paying attention to or waiting for that I think is going to be very, very important moving forward. So I want to kind of get into all of that this week. But you have to start off with Canada's CPI headline inflation. I think the expectation, I believe, coming into it was 3.8, and we got 4, so 4% headline inflation. Yeah, remember, just a couple months ago, we had headline inflation at 2.8% year over year. Everybody's celebrating. Krista Freeland's tweeting, going into keynote speeches, talking about, that we got the lowest inflation in the G7, and then boom, right back to 4%. Everybody's freaking out. But again, if you were anyone that was paying attention, that was listening to this channel, again, I don't get everything right. I'm prone to errors just like anybody else is. I can't forecast with great certainty about where we're going to be 12 or 18 months from now. But the math was pretty simple, which is we highlighted some research from Ben Rabideau. He's I think one of my go-to sources for research services that I subscribe to. And he put out a note, and he said, listen, based on our modeling, pretty simplistic, you have base effects, and if we model this out, you're going to have 4% headline inflation by the end of this year. And again, we can't guarantee the month of it. There's variations, but it was all sort of foreseeable. Now, we obviously got to 4% a lot quicker than expected, but we're at 4, and everyone's like, okay, well, what's Ben thinking now? Okay, well, Ben's updated research suggests that, again, we're going to have probably one more acceleration to headline inflation here in September, so you'll push up again. And then you'll probably start coming off, but again, you're probably going to end this calendar year with inflation with a 4 in front of it. CPI headline inflation is going to have a 4 in front of it. If it continues at the pace that it has over the last several months, you could have headline inflation back with a 5 in front of it. Okay, so it's very, very important when you're looking at the housing market, mortgage rates, what you think is going to happen, because what this is doing is it's feeding through into the bond market. It's very, very rare that Canada, an incredibly small country in the grand scheme of the global economy, moves markets. And this week, it actually arguably moved global bond yields higher. Everybody saw it, said, oh, holy smokes, inflation's reaccelerating in Canada, greater than expectations. Bond markets immediately started repricing higher yields as a result. So the Canada 5-year bond, for example, which is the instrument that basically prices your 5-year fixed mortgage rate, which is what the whole market really follows, moved up about 25 basis points just this week. And in the bond market, that is a huge move in a week, 25 basis point move. I can tell you that several lenders, and more will follow next week, are raising mortgage rates once again. So mortgage rates are back on the move. And a lot of this has to do with concerns around inflation, reaccelerating. Now, we did have the Federal Reserve out this week. They pretty much came out and said, listen, like we're more or less done. They might squeeze one more hike in. That's what they're all sort of forecasting. Again, they tend to get forecasts wrong, but that's kind of the Fed's expectation. The big sort of little tidbit out of that Jay Powell Fed speech was actually that he said soft landing is not his base case. And I think it was actually a slip up. I don't think he actually meant to say that, but deep down he knows it, that the soft landing narrative, when you take rates from 0 to 5 in the span of 18 months, it's going to break a lot of things in a highly indebted global economy. And so this is what we're basically now at the point is things are slowing. So housing is slowing once again. Obviously, we had some activity. We had an uptick in activity throughout the spring market as rates came back down, 3-year fix, 4.89. We had a little bit of a summer blip as well, which was people saying, hey, listen, my rate hold expires in September. I've got to use this 4.99 rate. before September 15th, so I better get out there and make a purchase. And now all those like attractive rate holds are expiring, and you're getting buyers today in the sixes, and now we're getting into 6.2, 6.4, 6.5, and I can tell you, I follow these mortgage rates on a weekly basis. I pick up the phone and I call basically every bank because I have a mortgage contact at every big bank and say, what's going on with rates? I've been paying extremely close attention to it. I just actually secured the last property in my land assembly in Calgary. So I've got to go put a mortgage on that. And so one of the things I'm thinking about actively now is, okay, how do I want to play this? Again, if your plan is to redevelop, let's say 3, 4, 5 years down the road, but you want to strap this thing with some debt. I know. Are you at the point of, okay, is the Bank of Canada done? Are they going to squeeze in another rate hike, 25 basis points? Do I float it with a variable? Because variable is actually cheaper now than your 1 or your 2 year fixed rate. Or do you have that peace of mind, go to that 1, 2, or are you going longer duration? I'm of the view now that these rates are going to break things. It's just a matter of how long is it going to take. I would argue that it's taken a lot longer than people would have anticipated. I think that, again, coming into this calendar year, here we are in September of 2023. If I told you that, the average mortgage rate in Canada would be somewhere in the sixes, and year to date, Vancouver home prices are up 8.5% year to date. I don't have the exact figure for the GTA, but I'm pretty sure the GTA, for example, is up. I know Calgary real estate prices are up year to date. Nationally, we're up year to date. Very, very unusual. The S&P is up, 13%, something like that so far this year. So it's been surprising that nothing has really, really broken. We've had a couple U.S. regional banks, but you're just waiting now for like that financial catalyst. And I do love it when everyone's like, everybody. I haven't found one person that's not in the view of higher for longer, higher for longer, higher for longer. And again, this is, take it from me. I didn't expect 500 basis points rate hikes. Totally got that wrong. Yep. But the fact that everybody is now in the boat of higher for longer, higher for longer. But what happens when the inevitable financial event hits? It always does. There's always some sort of event that nobody saw coming. It was the 2000 stock market, the global financial crisis in 2008, long-term capital management, 1998. There's always some sort of event. Obviously, the pandemic in 2020. There's always an event that triggers some sort of crisis. And you have to think, you're basically just sitting here now and waiting for that event. I don't know when that event's going to be. It could be 2 months from now. It could be 6 months. It could be 12 months. It could be 18 months out. But you have to think that event is coming. And when it does, it's going to shake the bond market. And that's when you're going to get that opportunity. I believe you're going to see these lower rates. Again, for how long and when is anybody's guess. But I think it's interesting to see that everybody's of this notion that it's higher for longer. Growth is still really good. Inflation's here to stay because growth is going to be good forever, and you're not going to get this like hard landing. And so the narratives around soft landings, I think, is actually like peaking around all-time highs. And you can see every time there's conversations around soft landings, there tends not to be the soft landing. So that's kind of what I'm sitting here waiting for. And I think it's important for anyone that's looking now, looking to make real estate decisions, is you're like, okay, I can understand people's desire to push real estate purchases ahead in the spring or in the summer, when you had, again, a 4.89 mortgage rate. It came down from 5.5 to 4.89. Doesn't look that bad. The Bank of Canada moves to the sidelines. Now you got rates. All those have expired. You got people now in the sixes. I can tell you, I'm getting quoted right now, 1 year fixed at 7.25, 2 year rates around 6.8-ish. And some of those are going to move up next week. So like these short-term duration loans, which is what a lot of people have been using, right? The most common product has been the 2 and 3 year fix, predominantly the 3 year fix. I think it ended up making up close to 60% of a mortgage originations over the past year. And variable rate mortgages, which is nobody's gone with, as I'd argue that you're probably more or less at the end of the Bank of Canada's rate hiking cycle. Only 5% of the market has been going variable over the last 12 months. We're actually starting to see anecdotally an uptick in variable rate product origination over the last couple weeks, with what we, the market seems to think might be the Bank of Canada moving to the sidelines. But it's interesting to see how people are starting to position. But you've got these rates now basically close to 7%. You're like, well, what's the point of waiting, or what's the point of rushing to push a real estate decision right now? Like, what is the catalyst to make you want to buy? With basically a 7. Now I understand, sure, maybe you can get attractive 3-year fixed with a mortgage broker doing some discounting, and you'd locked in early enough, you might be able to get it at 6.4 today, but it's still, the point remains, buyers have lost a sense of urgency, and you're starting to see that now in housing as listings, I would say, continue to come on. Certainly not a plethora of listings. Listings are running right around normal levels, but it's allowing inventory just to slowly build, very slowly. You're building up a 20-year low, for example, in Greater Vancouver, 20-year low base. So it's going to take time. You don't have an oversupply, but listings are starting to, take longer to sell, and that just adds to the inventory levels, and slowly over time, those inventory levels will build, and they'll build, and that slowly, gradually puts downwards pressure on prices. Sellers then have to start reducing prices. Buyers have more ability to stick it to sellers and dig their heels in and have the upper hand in negotiations. So that's kind of how I'm looking at the big picture. Is, again, don't be surprised if CPI headline inflation moves here from 4 to 4.2, back down to 4, back down to 4.5, and finishing the year at 4.6, 4.7, could even hit 5. The big variable here is, gasoline prices driving the bulk of CPI. Obviously, everyone's concerned about what's happening in the oil market, moving up to $90+ a barrel. Again, need I remind you that in the summer of 2008, oil hit $133 a barrel before eventually crashing down to something like $40-45 a barrel. So again, I'm just thinking that something is going to break here. I don't know what it is. We know there's stresses out there building. We've talked about in the show, commercial real estate. We know that a lot of that has gone no bid, a lot of bad loans on banks. But again, you think about a lot of these institutions that are sitting on, long bonds, for example. And if you mark to market some of those long bonds, it's down 40% since TLT, for example, is down 47% since peaking back in 2020. So I think there's a lot of institutions and banks sitting on unrealized losses, and you just don't know where that catalyst is going to come from. But I would say that's my watch at this point. I think it's pretty much set in stone that rates at these levels, mortgage 30-year fixed mortgage rate in the U.S. is 7.3, 7.4%, highest in 22 years. I don't know. It's going to take time. I don't know what it is. That's what I'm watching for. So, and as always, hope that helped. Continue to watch the bond market. The volatility there is insane, and it's certainly not what I would consider healthy movement in the bond market, and that is pretty telling. So, as always, hope that helped. We'll see you next week.